So I didn't do anything. They decided to sit like this. The broker sits in the middle. Ashish runs Avendus's M&A practice for IT, right? And the two investors sit on the other side. Raul, who runs Fidelity, and Ashish, who runs Helion. And other Ashish is an acquirer. He runs Naspers India business, IBIBO, and also he recently acquired Redbus. And Samir was the co-founder of Ex-Indiagames, and now on to your second venture, right? So let's spend the next 20-25 minutes and crisp, straightforward talk, right? The context of this conversation is, if you look at Indian venture ecosystem, to my mind, there are many issues, but the two issues boil to the top. One is a perpetual complaint we hear that there are no M&As, there's no exit, IPOs take forever here, right? And the second issue which we'll tackle in the next conversation is around lack of seed capital. We not have enough companies coming to be fed into the venture ecosystem. So with much ado, let's get into the first part of the conversation. And let's start with Ashish. You are on to your second fund, and I'm sure when you raised your second fund, this was the most important question that you had to answer. What dreams did you sell to your LPs?
It gets slightly worse. We are on to a third fund. So I think the dream that is sold largely to our LPs is hope, because there are no numbers, or the numbers that are fairly abysmal. So it is largely looking for investors who do believe that, yes, there is only one way that India can go, which is up, and they have the patience to hang in. And there are enough folks like that who are willing to buy a dream, which continues to be the basis of this. But if things do not pick up from the perspective of exits, the merry-go-round will stop at some point in time. So we are 7 years into our fund. And I think I would probably say maybe 10 years. What would you say, guys? 10 years, and then people will start saying enough of this. So we are still in that honeymoon phase of early stage investors and venture investors coming to India.
What does the dollar rate mean to you, 65 rupees, for your first fund and for your first fund, second fund? What's the implication?
So, it just makes the implication significantly worse. I mean, Redbus, for example, where Ashish and I work together, Ashish and I work together, imagine those conversations. We came in when the dollar was 40 rupees, and today it's 65. So whatever you do, you just get clobbered. It is just significantly worse than what it would have been just from a returns perspective. So it just makes the picture that much worse. There are a few exits, and the ones that are get beaten up, at least at this point in time.
So if you were to think of your next fund, which is not deployed as much, right? Does it play out to your advantage? Do you have a belief that the rupee will correct? Can the reverse happen? Can rupee go back to 40?
So I wish I knew. I don't have a view on whether it can go back to 40. I definitely hope that it goes back to 40. And this was not so we raised our last fund last year, and between then and now the rupee is depreciated from 45 to 65.
I have to pay fees of my son.
And so this is, it is a fairly serious issue. I mean, I just finished an LP trip, literally LPs, investors in our fund, literally a month ago. And they talk about, of course, exits, they talk about rupee, but the third thing they talk about is governance. And on the exit side, unfortunately, that also is a challenge, because we've had a couple of companies that have come very close to exit, and then they blow up in the investor's face because somebody's been stealing from the till. I won't name any names, but there are at least 3 examples that come to my mind. So that is yet another...
So there is this notion that I think Ganesh also mentioned, that we really don't need billion-dollar exits. Even 10, 20, 30, 50, 100, $200 million exits are good enough. Does the venture model, can the venture model sustain on these kind of exits? So assuming those could happen.
Absolutely. So the venture model can't sustain on those exits for the size of funds, for instance, that I have raised. From an entrepreneur's perspective, I think it is absolutely a worthwhile thing to consider. In fact, some of you probably have had conversations with me where if you can build a company without raising any money, you should. And it works for smaller angel funds. But after you've raised $200 million, which several of us have, it just doesn't cut it, because you have to line up so many of these that it won't look like a portfolio. It will look like a dance club or something of this sort. There will be hundreds of people swarming around there, and we won't be able to do justice to anything. So no, it doesn't work for the venture model.
For the size of fund you have, you need to create at least $1 billion exit, if not more.
We need to, so the math that we've run, we need to create at least $500 million exit plus at least one of them, and several exits that look like $200 million. Right. And then the math begins to compute.
So we're going to think about it, how we're going to achieve that in a while, but let me involve Raul into this. So Raul, we have a new RBI governor, and the shit is happening across him. Rupees lost in last 1 week, I don't know how much, 10 rupees, right? And he was brought in to actually control it. And you go on to meet him as a VC, and what would you tell him to do?
You know, Rajesh, actually, in my view, the economic problem that we need to solve is actually quite simple. You know, without going into the detail on the numbers, essentially the whole collapse started when there was a spotlight on our $70 billion current account deficit. You know, that, right. It's 80, Chidambaram's claimed it'll be 70. And when you go through the math, India has consistently, even through these difficult times, been able to attract $25 billion of FII regularly, $25 billion of FDI regularly, and then there's FII debt flows for another $20–30 billion. So actually, just from an economic perspective, all we need to do is be able to increase that by 20%. And the way to do that is, of course, make this country just a little easier to do business. I come to your conferences. I think they're, by the way, you run a, this is a side but important one. Firstly, you started us out at 6 in the morning, and then you've put us on a panel at 6 in the evening. 6 in the morning, you made us run.
We're going to party tonight, full night. A lot of people are going straight to the airport next day.
Yeah, but I love these. I love these sessions. I think it's just so cool. But I look at the people over here, and the cost of doing business for them, for the entrepreneurs over here, is so difficult, let alone for the foreigners, just for us. And so, you know, frankly, I would just talk about making it easier to do business in this country. The problem is, the economic problem is easy. The political reality is so divorced from the economic problem. The minute there is a little more convergence between the political reality and the economic reality, I think we can do something. I'm an eternal optimist. I think this might be getting close to the worst. And I do hope in a certain way it gets worse and it gives us a real wake-up call. I mean, I came back to this country in 2005. And at that time, everybody walked around saying 8% is a God-given birthright of growth. You know, I think we need a little wake-up call.
So let's go back to now, again, IPO kind of exits, right? I wonder if we can do $1 billion M&A exits in this country in next 1 or 2 years, right? I think that could be 50, 100, 200 kind of game, right? So if you have to build $1 billion kind of $500 million to $1 billion plus kind of companies, then it has to come from exits in IPO markets, right? And we had this Just Dial IPO, successful domestic IPO, that is another issue. Can you visualize, in your views, looking at the companies that have come up in the pipeline, do you see a few $500 million to $1 billion exits in next 2 years, whether in India market or NASDAQ? And you analyzed everything here. You're a late stage investor.
Yeah. No, you know, it's very interesting, Rajesh. I think the positive here, and I just looked at this earlier today, you've got to have companies that are the right for acquisition, and I'll define that in a minute. And then you've got to have a buyer or a set of potential buyers who have the acquisition DNA. Right. I think we're very lucky in, at least just let's take the digital media space. Google, Facebook, and Yahoo, between them alone, in the last 24 months, have acquired over 100 companies. So you've actually, forget, there's Naspers, there's Rakuten, there's a ton of others. So you actually have a very, very DNA acquisitive buyer universe. That's the positive. Second is I just looked at this, four of the largest 5 financings in mobile were done outside the US. We're sitting on something very exciting potentially in mobile.
Right.
So that side is there. But then when I look at the reality on the ground, this country has produced 5, maybe 8 companies that are above 100 million in value. And so, there's something missing. And what you really need for the acquisition is A, some very exciting technology. B, just unbelievable customer momentum, something that your customers just absolutely love, the product that they're just raving about. I have a feeling Flipkart probably came closest to that in its early days. Or 3, something that just has such a local edge over here that a global player finds it difficult to replicate that. And I think to your answer, will we have that? If there are enough people in this audience who are building things that have either that unique technology, that mad customer following, or that local edge, yes, we will, because the buyers are there. I mean, I really think that the foreigners, are dying to come in. We just give them too many excuses to stay away.
So tell me, Samir, from founders' perspective, do you see Indian founders building companies that have mad customer following or unique IPs or something that either the international buyers or the IPO market value and building it at scale and at a fast pace? And that's what is required, right? For us to get great IRRs. What's your sense? You grinded through Indiagames for 10 years?
Yeah, so let's step back for a second. I mean, I think for us to have any kind of reasonable M&A exits, whether it's 100 million or whether it's $1 billion, the first thing we need is the marketplace or the ecosystem has to develop so that the companies can scale to a stage. So the question we have to ask ourselves, and I'm going to take us slightly, so, as an entrepreneur, as a founder, you have to have irrational optimism. So I'm going to take the irrational optimism route at this end of the table, chair.
Yeah.
But, so here's the thing. We rode that entire wave of hoping and waiting for the great mobile consumer internet economy to start taking off. And we rode that through. And I think we lucked out at Indiagames, and we got an exit, and it was reported 80 to 100 million exit for a company that was doing about, close to 20 million revenue. Decent valuation, I would say. The point is, but we were one of the few lucky ones. Many tried, worked hard. The marketplace still wasn't there. But the fact that we're now doing about 3 million data activated just Android devices, we always felt that when we cross the 100 million mark, the virtuous cycle will start kicking in. And I can see that every day. So somebody who's been through that grind, I'm enthused every single day with the prospect of the marketplace coming up. Once the marketplace comes up, then I think that sprouts a lot of scale, and with the scale comes companies. I don't think they're short on ideas.
So let's talk about the scale thing.
Yeah.
Facebook doubled its number from 38 odd million to 80 plus million. We know that, right? In last 1 year. And it's being driven by mobile. We also know that 56, 70% is now mobile centric.
70% is mobile, yeah.
Mobile centric.
Yes.
So the scale is there, right? Why don't we build smart, great products?
Yeah, but that scale's coming from something like an FB, right? Which has already got $1 billion.
Yeah, but FB is the leading application on a mobile phone.
Right.
If you create other compelling content there, the scale is there. The devices are in the hands of the people.
But this is just happening, which is what I'm saying. So if we are where do we go now? I'm saying this is actually the most interesting time to be setting up for several reasons. One is because there's gloom and doom all over. People think that it's a bad time, and that's probably the best time to be actually setting up.
Absolutely.
I think it's. And in this context, you will see that growth, you will see that scale, you will see companies emerging. Now, whether you make $1 billion, let's say to get $1 billion valuation when you're a hot company, you need to be maybe 70 to 100 million in revenue.
Right.
In 2 years, it's hard, even with all the optimism, to think, because even if you get consumer scale, and let's say Raul gets interested and says that you've got consumer delight, and you have local customization or differentiation, somebody down the line, which in the investment committee is going to say, but what are we paying? Are we paying 20 times revenue? And we'll push the envelope to maybe 10 or 12 times because it's been done, but do we really want to pay 20 times? And monetization is a problem in India. So, and that was waiting for, because the monetization happens at such, the shampoo sachet levels, that's when you need the hundreds of millions of customers. So,
so it's like saying we have 100 million customers, but in the European or US context, you really have 15, 20 million.
Exactly, right? Exactly. So I think 4 or 5 years out, we might get to start seeing that. But in 2 to 3 years, to get billion-dollar exits is going to be I think rare, and there will be black swan events. But are we headed in the right direction? I think we're in a better place than ever before, not in a worse place. Now, it's different things at different times. Fundraising environment may not be great, but I think to set up something, because the ecosystem
it's a great time to be a founder.
The ecosystem is cresting, and that's the time you need to start sort of launching out, so that when it crests, you're there with a product.
So Ashish, Naspers and various different arms of Naspers and Tencents, and they're all collaboratively taking a call on India. There are different sort of now 7-year history. On one part, you're building an organic business. On the second side, you've taken a stake in Flipkart, and then on Redbus, you have acquired it. So how do you see value creation for a player like Naspers happening in the scheme of Naspers things, where it will be driven by building a multi-billion-dollar business out of India? So give us a sense of how the thinking is happening at Naspers.
So a couple of points, right? Firstly, for the audience, right? So it's not Naspers. Naspers is, of course, our principal, but it's IBIVO Group, which acquired Redbus from Ashish Gupta and everyone else, and Funny. It was because we had the conviction, because of the fact that we had organically built the business and scaled it in no time. Of course, backed by very robust, globally very, very sound principles. But I think as buyers, we had the courage, the gumption, and the belief that this acquisition will further scale our ecosystem out. And I think that's the right direction. Of course, it always has its teething troubles and so on and so forth. It's a very complex thing. It's not just a financial investment. But the point I'm trying to say is this, that because we as an asset had scaled at $1 billion plus run rate, that enabled us to acquire. Okay. And then that further enabled the flywheel to take off. I think on your next question, or the problem statement that are there enough buyers, I think the problem is that there aren't enough scaled buyers in the market, very, very few. And that's really the whole issue. Till those scaled buyers don't get built, it's like a eBay marketplace. If there are buyers, there'll be sellers. If there are sellers, there'll be buyers, right? So that network effect hasn't really taken off, really, because there aren't enough scaled buyers. That is really the problem statement in the market. And I guess with the growth of the fundamentals, that problem will sort out. And on the sell side, platforms like yours are creating. So I'm pretty hopeful. On your next question, indeed, I think we are already on the right path in terms of, I think if I look at today's date, from my ecosystem which I've developed organically and inorganically, I should be, after railways, the biggest transaction processing house. That's scale, right? When we're talking hundreds of thousands of transactions. You've seen us build lots of internet businesses, and that really, the problem in India is that comes through a lot of patience and a marathon. You can't build businesses in like in US, you build in 2 years, you get traction, you've got a global acquirer like Facebook. I mean, this has to be the local ecosystem which has to take off in a patient manner, in a marathon manner. I don't think there's going to be a J curve in this market. It has to be built patiently, and we've seen it, right? We've seen failures, we've seen successes, and that's how we look at it, right? On the question of acquisition, actually, we've been very active. We don't talk about it. We do lots and lots of acqui-hires. And we don't talk about it.
How many companies your group has bought globally, and in IBIVO Group, how many companies you bought so far?
So Naspers is really acquisition savvy or investment savvy company, and it would have actually invested in close to 80 to 100 companies globally. Okay, and the models are different, right? So a Redbus or a Gari acquisition kind of a model is that goes through. That's really my passion. as the entrepreneur for that business, along with other partners, that look, we must do that business, right? Naspers is free to do any other business or invest in any other business parallelly. So, I mean, the point I'm trying to say is that it's not just one corporation wanting to acquire, it's about the buyers. Do they believe in it? And that's really important, and hence, in this market, do we have enough buyers who are scaled and then believe in someone's story to take it to the next level?
Obviously, we don't have enough domestic buyers of scale right
At this
now.
stage, unfortunately, we don't, and neither do we have enough sellers, to be honest, who are tracking fast, who have a huge traction. I think the issue is the network effect between the sellers and buyers is not yet taking off.
Okay. So we'll come back to that. So you're looking at both sides of the equation, right? You have buy side, sell side, all kind of mandates. And I remember we had a conversation sometime last year, late last year, early this year, where you hosted a conference where the big private equity players, Carlyle's and Blackstone's, and they were sort of hesitating to take part in this digital tech story of India. What's behind that hesitation?
So I think a couple of things, and it came out clearly at that event that we'd hosted. One of them is the fact that many of the growth equity players, Rajesh, are on a back foot themselves. And this is true for the investor community in India across the board. As Ashish was capturing, there are lots of factors in the macro environment that have not gone well for the country. We've gone through a recession. You've done most of your investing at a time when the winds were blowing very differently. So a lot of people are working and churning, through their portfolio, and the exits are not visible. And a lot of LPs are asking the question, why India? Because we're getting great returns in our traditional markets with much lesser risk, and we're seeing exits. So I think that's one big issue for many of those people. They're working through their portfolios. They're trying to focus on figuring out where they're going to get their exits from. And in that kind of a situation, they can't be taking very risky bets. And I think that's one point. And the second point is that many of the companies that are seeking growth capital are not, in their business models are not fleshed out to a stage that will make those people comfortable. What growth equity investors in India want, without exception, is capital protection at the minimum. And even businesses that have reached a stage that are raising $50 million or even $30, $40 million and above, which is where those players play, there is a risk of capital erosion, and those people are just not in a position to take that, especially given the precarious situation that they're in. I think what is missing in India, and there are a few players who play in that space, is what one would call a late-stage VC. In the US, you have a fairly deep late-stage VC community. In India, there are a few people. I mean, you look at a Tiger, you look at an NEA, you look at Sequoia, and some of these players, they do play that late-stage VC game. But they have also been forced, for various reasons, largely because valuations in good markets go completely out of whack. They're forced to go very, very early as well, and therefore your portfolio becomes slightly confused. You can't be clear about, okay, this is the stage that I'm good at investing, and therefore I'll stick to that. So I think it's a host of these issues which really adds up to these growth equity guys not participating very actively. Having said that, the positive part, and I think all of us, if we open up the house, everybody's going to have negative things to say. So it's important to focus on the good things that are happening. I think that community is engaging. Okay, so I think according to me, it's a matter of time. We get called in by all of those people to come in and talk to them about what's happening in the digital market, in the technology space, which are the companies that are showing signs of maturity where they can get involved. They're all thinking about whether they should have different models. Should they carve out a small sort of pool of capital through which they'll take slightly riskier bets and so on and so forth. And that's not translated into investments, but I think it's I mean, Warburg, who's a very typical growth stage, equity investor, invested in Quicker. Quicker is a scaled-up platform, but it does have, a lot of the risks associated with, with risk capital, and therefore, to me, that was a very encouraging sign. And I think over the course of the next couple of, years, we will see a lot of those players get into the space, and I do think, to that point, secondaries to other VCs and other private equity players, at least until we get a little bit of tailwinds behind us, is going to be a very important part of the exit of portfolios.
So let's focus on this 10 million, 50 million space of exits. How do we? My sense is we can develop that market domestically, right? Do we need to depend on foreign capital for those kind of exits?
Foreign capital, a product company which has done POCs, and therefore people say, you got something, now you can stick it in somebody else's sales channel and grow it. And then there are the other kinds of companies which you can call operating heavy companies. I'll take a classic example, services companies. You keep plodding around that curve and later on. I think if you're looking at the first class of companies, the innovation-centric companies, there are very few buyers in India, because there are very few companies that have an established sales channel in which to stick an innovation and take it to market, whether it is security, software, blah, 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 blah. So for that, you definitely need folks who are from the outside to come start buying that. And there is growing interest in that. For instance, okay, so that is one
enterprise side, probably more at this point of time.
Yeah. On the other kind of companies, there are more domestic buyers also, because there are operating companies in India, and now the IT services guys are also getting into the game, where the operating businesses can be plugged into an existing engine and grown. So I would break it up into those two. For the first one, we do need international. Right. For the second one, I think domestic buyers should be sufficient.
Got it. So let's go, I'll come back to you, Ashish, but let's go a little bit on late stage VC missing piece. I know you play in that space as well. You have a different kind of a portfolio approach. Why are you not getting excited about that? What does need to happen on those companies to create operating leverage or margin expansion that will blow your mind out?
Yeah, Rajesh, that question is quite easy, because if you look historically, as I said earlier, there are literally 5 or 6 companies that have crossed the $100 million mark in valuation. Let's say it's literally Just Dial, Make My Trip, Naukri, Flipkart, arguably, Redbus, if it was a dollar deal. I'm saying if it was a dollar deal, yes. But it's, maybe I'm missing 1 or 2.
Yeah. The fact that 5 of us have to pitch in proves the point.
And if you're playing late stage and we're coming in with, let's say, $20 million of capital, and you're looking to make 3x your money on that, you need a couple of $100 million, if not a $500 million exit. And so we've been forced, our sweet spot, most of our first fund of $250 million got deployed in some tech services, healthcare, in the $10 to $30 million range. But when we started looking at digital media, when we started looking at some of these cloud companies, etc., we're forced to go earlier, because our hypothesis is, if you're an entrepreneur, you should assume if you get an exit, it's going to be a sub $100 million exit. There may be a black swan event where it will be more than $100 million. And therefore, for us to play, we have to come in when the value is, call it 20 million, 25 million max, in order to make some money on our own investment. And so that's what's forced us in this current ecosystem to come back and play into the Series B space also. And that's what I think the gap is. When you're a $200 million fund, you don't want to deploy 25 million in an investment where there is risk of loss of capital. Now, if you're a $1 billion fund and you're a Warburg Pincus, you can take that risk.
Right.
If you switch your mentality and say, look, this is a long-term thing in India, you can take that risk. But for someone like us, when we make our $20 million funds in a very stable services company, we're not losing capital. And so that's what's forced us in this space. Now, I think, the entrepreneurs are also learning, and you're beginning to see a lot more models. I disagree with Vani this morning when she said we have solved the scale issue.
Yeah,
I don't think that's right. I think most VCs, when they look at companies, say, how big is the addressable market? For each of your companies, that's one slide you probably made them throw up over there. Addressable market in India remains a key question. And yes, you do have scale in terms of number of transactions, but it's not translating into revenue made off those transactions. And therefore, I think entrepreneurs are becoming smarter. You are seeing a lot more, pan-Asia plays. You're seeing a lot more, Middle East, Africa plays. And it's all addressing this issue because we don't have scale at our current level. Now, the optimist in me says, mobile phones today, smartphones have crossed the number of PCs in this country. Is there something we should do there? There is absolutely no reason Waze or Instagram could not have been created in this country.
Absolutely.
So I don't know, is there, and that's why I said, those three criteria, is there some very interesting technology? Is there some absolutely crazy, passionate product with a customer? And I think that's the only thing. I don't see it today, unfortunately, but with the kind of ecosystem that you're helping create over here, I think maybe the next 10 years certainly will be better than the last 10.
So Ashish, you talked about buyers and supplier of capital and all of that. Let's talk about founders. You deal with them, they're the important players when the transactions happen, fundraising or exits. What is the psychology? What kind of founder psychology you're finding around exits and around raising of capital?
So Rajesh, I mean, there are all kinds. I don't think any two founders are the same. But obviously, one thinks about when one looks across the board, you try to think about what are the common traits, amongst the more successful ones. And the one thing that at least we've seen is the one trait that we've seen across the successful founders is extremely deep-rooted conviction about the business that they're building. Very close watch on their value proposition to their customer base, looking ahead at what are the risks and anticipating them and trying to solve for them in advance, and not really doing it saying for the 10, 20, 30, 40 million dollars that they will make in 2, 3, 4 years of time. I'm not sure. I've seen many people who are very focused on exit from the beginning really get to very successful outcomes. I think it has to be something. The most successful exits, I think, are if you've built a company where there are lots of buyers and you don't want to sell.
So let's take another shot at this. Go 5 years from now and think in next 5 years how many exits in IPO market we can do of, let's say, $500 million. Let's not talk about $1 billion. How many companies are being primed in this market for $500 million exits?
So I'll come back to your...
But you've done analysis, right?
So I'll come back to you. Yeah, I'll come back to the IPO bit in a bit. But one of the questions that you asked earlier is how many large companies are getting created. And I think that is one area where India has actually done amazingly well and the story doesn't get spoken about. In the last 3 years, there are more than $5 billion venture-funded companies that have come out of this country. Okay, you have Flipkart, you have Make My Trip. All of us will agree that it is undervalued at this point of time. You have Just Dial, you have Mu Sigma, and there are others. I'm missing a couple. So I think you're beginning to see billion-dollar companies, and therefore I personally believe that there will be many more going forward. I think people just, unfortunately, we are at a stage where you have a lot of headwinds, and none of us have a clue as to when those headwinds are going to neutralize or get converted into tailwinds. And I think people just have to be smart about the markets that they choose in this period. And you're seeing, if you looked at your own sort of portfolio of investments that presented today, there's so many of them who are talking about targeting markets outside of India.
Right.
Get your proof of concept here and then go and work in other markets. And not everyone will be successful, but you have to solve for that issue both from the headwinds perspective as well as the addressable market perspective that Raul spoke about. I think we as Indians are eternal optimists. So I personally believe that the Indian capital markets has the appetite for large sort of IPOs, and I think the Just Dial IPO proves that, but they have to be very solid sustainable businesses that are built on fundamentals, you know, that are developed over here, and not just quick flips. Because if they're quick flips, you know, this is not the market.
So I took one call, a couple of calls when I started thinking about GSF. One we converted, have told we're mobile only. Every company of GSF is mobile. And not in the sense of mobile first, we're saying you're mobile only. Get that thing right. And the second call we've taken is that we're not just building for Indian markets. Yep. And substantial part of our portfolio is now looking at markets outside India, as you said. Because our belief is that, one, there is a capability here to do that. And we are also shifting our mindset from product to services, as you mentioned. And the second belief is that perhaps that's the better way to get exits, even acqui-hire exits, right? Not just IP exits, but even acqui-hire exits. So that's driving even an accelerator like us into building its portfolio in a very different sort of a way, driven by the exit potential. So coming to you, you have started your new venture, part 2.
In stealth mode. I'm kidding.
Yeah, so it's publicly announced. So how do you sort of think about building this company, raising funds, priming it up, creating exits for your investors? What's going on in your mind? And you are a serial entrepreneur who's done an exit, has created liquidity and return for it.
Ganesh's comment about, you know, it sounds ridiculous when you hear about the whole idea was to do something that is exciting and different, and I'll talk about that just a little bit. But I think what I'm doing right now, if I came with a business plan to the investor community here, no one would think of backing something like that, because it's kind of offbeat. And coming to that part, I think what we have done so far in India and even in the West is that we've created a lot of wealth and opportunities around, you know, in tech and media, but we've not really ever focused on liberating the creators. And the creators have kind of been left in the background. Is there an opportunity to make, why is it so much harder for a writer or a DOP or a photographer to actually, why is it harder for them to find a job versus a C++ programmer or a Java programmer or something like that? It should be equally easy for them, and we've not created those opportunities. So I think there's a renaissance coming. I think the next revolutions after the manufacturing and the software and the services revolution, there will be, again, a creative revolution. And that's really the big punt. And can you make a business model out of that? And I want to be focused around India, because I believe that we will be a creative superpower. We are a creative superpower, and can we actually build a business model around that? And so I'm kind of, you know, using whatever I've learned in mobile.
And you put your own
business.
capital behind it.
Yes, and so it's a big personal bet. And so that's the thing. The ridiculousness of this idea.
Big round of applause for him.
Yeah. Well, we'll know in some time. It's not a fundable idea. I think it's a great idea.
You're backing your conviction. You're backing your conviction.
Yes.
You put your money behind this idea, right?
Yes, exactly.
Right. So Ashish, from your perspective, you're driving the whole strategy of a very big group. What's exciting in India?
So I think number one, what's exciting and which has changed from the time I built a business with you, V1 of e-commerce, is that there is much more supply of talent. The creators, right? Whether it is.
Can you hear him? Yeah.
Yeah, can you hear me? Okay, let's move it. Yeah, so the big difference between the version 1 of business which I built with Rajesh, I think the first era of internet, from now, is that there is a supply of talent, both on the creative side, on the C++ type engineering side, which was really missing. And that means that you have the creators to be able to produce and solve problems, whether for global market or for local market. So as a result, one is able to execute faster. Then the second big difference is that today's date, if you understand the problem, you can produce the proof of concept at a very, very low cost. Like in 5 lakh rupees, 2 lakh rupees, maybe even free. I remember there was a time when a server and the bandwidth used to cost so much. But today's date, you can just do it out of the cloud, or you could even do it out of a hosted service, but at a really, really low cost. I think that's the second big difference. The third big difference, of course, is that the consumers are now beginning to use services, transact with services. The volume of consumers have definitely grown. So I remember I think Rajesh and I were the first people to actually sell a domestic air ticket in this country. We launched this thing called airline ticket auctions. I don't know who all are here, who were with us then. And it took us days and night and sweating to do the first 1,000 transactions. And that was like a big, big damn. I mean, of course, that's missing, Ashish, and that's your pain area and our pain area. But to reach that scale, to justify that, yes, now the consumers are embracing the business, that's possible within months and days without sweating that much, because there is I think consumer traction, and there is that the fundamentals, the repeat behavior, the lifetime value, all those fundamentals are now there in the market. And mobile, of course, some of our businesses are now doing 25 to 30% of paid transactions via mobile. I'm 100% sure it's obvious that in the next 24 to 36 months, mobile transactions, I know there have been these reports that mobile is greater than PC, but for me, the proxy is really paying user. That's going to cross the PC desktop user. I think these are the couple of things which have happened. And then, of course, accelerators like you encouraging the young talent to come and produce.
Excellent. You want to have a comment? No, I was saying let's wrap up this conversation on positive note, because I do believe the future will be bright, and this is why we are here. This is the whole idea of this conversation. So let's get some positive thoughts in our head, all of us. Let's condition ourselves and say something positive about exits, about IPOs, about whatever you have in your head, about love of your life. Say something positive.
So I'd like to change the frame of reference. Even though this panel was positioned as exit and IPO, that is not the way one can go about either building a company or in the business that I am in. Otherwise, I should have been a trader.
Right.
The way, at least I look at it, and I think I looked at it as an entrepreneur also, is if there is an interesting problem to be solved in which I can create value while solving that problem, the math makes sense, if not now, at least in some foreseeable future. If the math doesn't make sense in the foreseeable future, I adjust my expenses. I don't run away from the problem. I think those opportunities abound. And there are enough and more companies that we have in our portfolio that I see in several of my friends' portfolios, which I envy, which are solving very interesting problems in meaningful ways, and they're creating value. Where will the rupee go? Where will the IPO market go? If we were wise enough to know that even tomorrow, I don't think we would be doing what we are doing. We would be trading. So let's treat that as an unknown. So at least my view is there are more than enough problems to be solved. There are more than enough problems that can be solved in an economically viable manner. So this is going to create something meaningful. How large, how small, if that was something that would be a big determinant of what I do, I wouldn't be an early stage investor.
Let's solve unique problem in uniquely different ways.
Absolutely.
Let's go back to our roots and start solving problems.
And those opportunities abound, creates enough excitement on a day, creates enough value.
That's the great spirit of India, right?
And it's beautiful.
Excellent. Raul, what do you see?
Just from our own experience, if you do have a quality asset, there is incredible interest. You can talk to any banker who's dealt with the process, and there is incredible interest. We exited NetMagic to the Japanese. There was an incredible interest in that asset. So there is, the positive over here is that there is incredible interest. What we have to do is just build that quality company. And it's okay if it's not above $100 million exit. I mean, if you look at Google and Facebook's acquisitions, the Instagrams are the exceptions. Most of their acquisitions are sub $100 million. And there is a thriving, I mean, the amount of capital that there is actually in Series A and B is incredible for this country. I mean, 10 years ago, entrepreneurs had no access to this capital. Today, there is a lot of capital. So I think it's all about, there is the buyer, there is the capital. It's all about just creating some products over here that, the customers just get rabidly excited about. And with differentiated technology. I think it is very useful. Second thing I'd say is I think it is very useful thinking of global models, adapting them over here. But I think what we are all looking for is when people say, wow, Red Bus worked over here. Why don't we build the Red Bus in Turkey? Why don't we build, instead of it always being, let's build the Dropbox, let's build the Facebook. And I think that's the next thing that I think, and I began to see some ideas being fleshed out over here.
Great. Ashish.
Yeah, Rajesh, this actually reminds me of a conversation at lunchtime with a few colleagues where, we've all in this gloom and doom sort of mode. And I made this comment, which I believed in then and I still believe in, which was, I believe technology can be a catalyst of change in India to get India out of the situation where it's now. And I'll give you examples. The one thing about India, given the market that we all understand, all the challenges we've spoken about, is every segment is hyper-fragmented and it's unorganized. Whether you look at the bus segment, as it was earlier, whether you look at the cab segment, whether you look at, used car segment, whether you look at, anything across the board. There are used goods waiting to be sold. People didn't have channels to sell it, so on and so forth. And I do think that if entrepreneurs, and so many of them sitting over here, can actually, endure the pain of, and you can go back and talk to all of these entrepreneurs who have built these successful companies. If they can actually endure the pain of trying to organize those markets, I think there's tremendous value to be created. And Ashish, as Ashish said, if that value gets created, there will be an exit. I think the challenge happens when you've tried to create, a Me Too in a market which is not ready for that, and that's where you get stuck. And I'm a big believer.
Yeah, we need to be original. We need to believe in ourselves and solve real problems.
Yeah,
absolutely. So why don't we give the final comment to the founder, because ultimately we're all serving him and he has to create the value. Say something nice.
Yeah, I'm just going to relate a story. I was talking to one of the early stage companies here, founders, and we were having this conversation. He's going through a rough time, and when is the right time to actually kind of call it quits? And I told him, there's a saying that it's better to have loved and lost than to have never loved at all. And when it comes to money, it's not quite the same. You feel like a fool. And at 39, if I could have made something and I'm risking it all again, at 24, what are you going to lose? The worst case scenario is you'll walk away with a ton of experience. You'll have a lot more experience than any of your peers in any job that you go back to. And this is another IITian. What's the worst that can happen? And when you embrace the worst that can happen, it doesn't seem so bad then. Because you're not going to put your kids in the street, you're not going to put your family, you're not going to really impact. You're doing yourself a huge favor by living your dream and doing this. And as long as it's fun, and at 24, you can't fool yourself. Maybe when you're older, you can kind of fake it, but at 24, you're just going to do what your passion is driving you to do. It's the best time to be doing it. The market's cresting, go out there and build it.
Excellent. I think we had a great conversation. Thank you, gentlemen. Our next panel is going to be on the seed investing. Sid is going to host it. Sid, would you come? And over to you. We also have Vish from Chennai Angel. Gopal couldn't be here. Thank you, guys. Yeah. Stick with us if you could for half an hour more.